Something just happened in the global financial system that most people are ignoring, but it could quietly become one of the biggest turning points in modern economic history. And if you are holding or watching XRP, this is not something you want to miss because Japan, the world's third largest economy, has officially ended its zero interest rate era after more than 30 years. And this single move could send shockwaves through global liquidity, banking systems, and cross border payments in ways that most investors are not prepared for. And the real question is not just why Japan made this move, but what happens next. And more importantly, how XRP could be positioned right in the middle of this shift as traditional financial systems begin to feel pressure from rising rates, tightening liquidity, and the urgent need for faster and cheaper global transactions. For decades, Japan maintained what is known as a zero interest rate policy, which means borrowing money was almost free. And this was done to stimulate economic growth after the country faced a major slowdown in the early 1990s. And over time, this policy became one of the most important pillars of global finance because it allowed banks, institutions, and even governments around the world to access cheap capital. And when money is cheap, liquidity flows easily across borders, markets expand, and risk taking increases. But now that Japan is stepping away from this long standing policy, everything begins to change in ways that are both obvious and hidden at the same time. When interest rates rise, borrowing becomes more expensive, and this immediately creates pressure across financial systems because institutions that relied on cheap funding now have to rethink their strategies. And this leads to tighter liquidity conditions globally. And when liquidity tightens, markets often become unstable. And during times of instability, the demand for efficient, fast, and cost effective financial solutions increases dramatically. And this is where the conversation around XRP starts to become very interesting because XRP was designed to solve exactly these types of problems in the financial world, especially when it comes to cross border payments and liquidity management. Now, think about this carefully because for years, traditional banking systems have relied on outdated infrastructure for international transfers, which often involve multiple intermediaries, high fees, and slow processing times. And in a world where interest rates are rising and liquidity is becoming more expensive, these inefficiencies become even more painful for financial institutions. And this creates a strong incentive for banks to look for alternatives that can reduce costs and improve efficiency. And XRP, through its underlying technology, offers a solution that allows value to move quickly across borders without the need for pre-funded accounts, which can significantly reduce the cost of liquidity. As Japan moves away from zero interest rates, global capital flows are likely to shift, and this could lead to a stronger Japanese yen, changes in bond markets, and adjustments in how institutions allocate their funds. And all of this contributes to a more complex and potentially volatile financial environment. And in such an environment, technologies that provide speed, efficiency, and flexibility tend to gain attention, especially from large institutions that need to adapt quickly to changing conditions. And XRP fits into this narrative because it has already been positioned as a bridge asset that can facilitate instant cross border transactions without relying on traditional banking rails. Another important angle to consider is how this decision by Japan could influence other central banks around the world because global economies are interconnected. And when a major player like Japan changes its monetary policy, it often triggers reactions from other countries. And this can lead to a chain effect where multiple economies begin tightening their policies. And as this happens, the overall cost of money increases globally, which again puts pressure on outdated financial systems and increases the need for more efficient alternatives. And this is exactly the type of environment where digital assets with real world utility can start to gain serious traction. At the same time, Institutional awareness of digital assets has been growing steadily, and many banks and financial entities are already exploring blockchain based solutions to improve their operations. And when you combine this growing interest with a shifting macroeconomic landscape driven by rising interest rates, the stage begins to look very different from what we have seen over the past decade. And XRP sits at the intersection of these two powerful trends, which makes it a key asset to watch as these changes unfold. However, it is important to understand that market reactions are rarely immediate or straightforward because these types of macroeconomic shifts take time to fully play out. And there are many variables involved, including regulatory developments, technological adoption, and overall market sentiment. But what makes this situation unique is the scale and significance of Japan's decision, because ending a policy that has been in place for over 3 decades is not a small adjustment. It is a structural shift that could reshape parts of the global financial system over time. As we move forward, the focus will be on how institutions respond to this new environment, how liquidity conditions evolve, and whether alternative financial technologies like XRP begin to see increased adoption as a result. And while nothing is guaranteed in the world of finance, the connection between rising interest rates, tightening liquidity, and the need for efficient cross border solutions is very real. And this is why the conversation around XRP in this context is gaining attention among analysts and investors who are looking beyond short term price movements and focusing on long term structural changes. To truly understand why this moment is so important, you need to look deeper into what pushed Japan to finally end a policy that stayed in place for more than 3 decades, because this was not a random decision and it did not happen overnight. And when you understand the reasons behind it, you begin to see why the global financial system could be entering a completely new phase, one that may quietly favor assets like XRP over time as pressure builds on traditional systems. For many years, Japan struggled with slow economic growth and very low inflation, and in some periods, even deflation, which means prices were not rising and in some cases were actually falling. And while that might sound good at first, it creates serious problems for an economy because businesses earn less, wages stagnate, and consumers delay spending, expecting prices to drop further. And this creates a cycle that is very difficult to break. So the Bank of Japan kept interest rates at zero or even negative levels to encourage borrowing, spending, and investment, hoping that cheap money would restart economic growth. But over time, the global environment started to change, especially in the last few years, where inflation began rising across major economies due to supply chain disruptions, energy costs, and massive stimulus measures. And even Japan, which had struggled with low inflation for decades, began to see price increases that were stronger and more persistent than expected. And this created a new challenge because keeping interest rates at zero while inflation rises can weaken a country's currency and reduce purchasing power, which puts pressure on both consumers and the broader economy. As inflation in Japan started to move beyond the central bank's long term target, policymakers were forced to reconsider their approach because continuing with ultra low interest rates was no longer sustainable in a world where prices were increasing and global interest rates were rising. And this is where things began to shift in a serious way because Japan was one of the last major economies holding on to this type of policy. And once it started to change direction, it signaled that the era of extremely cheap money globally might be coming to an end. Now, this shift does not just affect Japan alone because Japan has been a major source of global liquidity for years, and investors around the world have used what is known as the carry trade, where they borrow money in Japan at very low interest rates and invest it in higher yield assets in other countries. And this strategy has supported markets globally by providing a steady flow of capital, But when Japan raises interest rates even slightly, this strategy becomes less attractive, and investors may start to unwind these positions, pulling money out of global markets and bringing it back to Japan. This process can create volatility across financial markets because large amounts of capital can move quickly. And when liquidity starts to tighten, the effects can be felt in stocks, bonds, currencies, and even emerging markets. And during these periods of adjustment, inefficiencies in traditional financial systems become more visible and more costly, especially when it comes to moving money across borders quickly and efficiently. And this is where the role of XRP starts to come into sharper focus, because one of the biggest challenges during times of liquidity tightening is the need to access and move capital quickly without locking up large amounts of funds in different locations. And traditional systems often require banks to hold pre funded accounts in multiple countries, which ties up capital and reduces flexibility, especially when the cost of money is rising. But XRP offers a different approach by acting as a bridge asset that can provide on demand liquidity, allowing institutions to move value without the need for those pre funded accounts. At the same time, global banks are under increasing pressure to reduce costs and improve efficiency, especially as margins become tighter in a higher interest rate environment, and technologies that can streamline operations and reduce friction in cross border payments become more attractive, not just as an option, but as a necessity. And XRP's value proposition becomes stronger in this context because it directly addresses these pain points in a way that traditional systems struggle to match. Another factor to consider is how this shift in Japan could influence currency markets, because changes in interest rates often lead to movements in exchange rates. And as the Japanese yen adjusts, it can impact trade balances, investment flows, and overall market stability. And during times of currency volatility, the demand for fast and reliable settlement systems increases, because delays and inefficiencies can lead to higher risks and losses for institutions operating across multiple currencies. As all of these forces come together, rising inflation, changing monetary policies, shifting capital flows, and increasing pressure on financial systems, the global landscape begins to look very different from what we have seen over the past decade. And while many investors are still focused on short term market movements, the bigger picture is about structural change. And these types of changes often create opportunities for technologies that are designed to operate more efficiently in complex environments. It is also important to recognize that institutional adoption does not happen overnight, and large financial systems move slowly. But when the underlying economic conditions begin to shift, the incentives for change become stronger. And this is what we are starting to see now, because the end of Japan's zero interest rate era is not just a local event, it is a signal that the global financial system may be entering a period where efficiency, speed, and flexibility are no longer optional but essential. We are going to connect these macroeconomic changes directly to XRP in a more detailed way, breaking down how this shift could translate into real demand, what scenarios could drive adoption, and why some analysts believe this could be the beginning of a much larger move that most people are still not fully seeing yet. Now that you understand why Japan made this move and how it could reshape global liquidity, the next step is to directly connect these changes to XRP in a practical and realistic way, because this is where things start to become much more interesting, especially for those who are trying to understand not just the hype, but the actual mechanics of how something like XRP could benefit from a shift in global monetary policy. When interest rates rise across major economies, the cost of holding and moving money increases. And this creates a very specific problem for banks and financial institutions that operate globally, because they rely heavily on liquidity being available at the right place and at the right time. And traditionally, the way this has been managed is through what are called nostro and vostro accounts, which essentially means banks keep money parked in different countries so they can settle transactions when needed. But this system is extremely inefficient because it locks up large amounts of capital that could otherwise be used more productively. Now, think about what happens when the cost of money increases, because this is exactly what occurs when interest rates rise. Suddenly, holding idle funds in multiple accounts around the world becomes much more expensive, and institutions begin looking for ways to free up that capital while still maintaining the ability to move money quickly and securely. And this is exactly the type of problem that XRP was designed to solve through its ability to provide on demand liquidity. Instead of pre-funding accounts in different countries, XRP allows institutions to convert one currency into XRP, send it across borders almost instantly, and then convert it into the destination currency all within seconds. And this process significantly reduces the need to hold large reserves of capital in multiple locations, which becomes a major advantage in a high interest rate environment where every dollar of liquidity has a cost attached to it. As Japan ends its long-standing zero interest rate policy, and as other economies continue adjusting their own monetary strategies, the global financial system becomes more sensitive to inefficiencies, and what was once considered acceptable in a low rate world starts to become a burden. And this is why technologies that improve efficiency do not just become useful, they become necessary, especially for institutions that are dealing with large volumes of cross border transactions on a daily basis. Another important factor is speed, because in traditional systems, international transfers can take several days to settle. And during that time, exchange rates can change, creating additional risk for both the sender and the receiver. And in a more volatile environment where currencies are moving due to shifting interest rates, this risk becomes even more significant. And this is where XRP's near instant settlement capability becomes a strong advantage, because reducing settlement time also reduces exposure to currency fluctuations. At the same time, regulatory clarity around digital assets has been gradually improving in certain regions. And while the landscape is still evolving, there is a growing recognition that blockchain based solutions can play a role in modernizing financial infrastructure. And as institutions become more comfortable with this technology, the barrier to adoption begins to lower, especially when there is a clear economic incentive to make that transition. It is also worth considering how large scale financial shifts often create ripple effects that extend beyond their initial impact. Because when liquidity conditions change, it does not just affect banks, it affects corporations, governments, and even retail investors. And as these different players adjust to the new environment, the demand for more efficient financial tools can increase across multiple levels of the economy, not just within the banking sector. For XRP, this means that its potential use case is not limited to a single area, but could expand as more participants in the financial system begin to look for ways to reduce costs and improve transaction efficiency. And while this does not guarantee immediate adoption or price movement, it does create a stronger foundation for long term relevance, especially if the current trends in global monetary policy continue. Another angle that often gets overlooked is how psychological shifts in the market can play a role in adoption, because when major economic changes occur, they can change how investors and institutions think about risk, opportunity, and innovation. And in times of uncertainty, there is often a greater willingness to explore new solutions that were previously ignored or underestimated. And this shift in mindset can sometimes accelerate the adoption of technologies that offer clear advantages. However, it is important to remain realistic and understand that the relationship between macroeconomic changes and asset prices is not always direct or immediate, because markets are influenced by many factors, including sentiment, speculation, and external events. But what makes this situation different is the structural nature of the change we are seeing, because the end of a 30-year policy is not a short term event. It is a long term shift that can influence the financial system for years to come. As institutions begin to adapt to this new reality, the focus will likely shift toward optimizing liquidity, reducing costs, and improving efficiency. And these are exactly the areas where XRP has positioned itself as a potential solution. And while the timeline for widespread adoption remains uncertain, the direction of these macroeconomic trends suggests that the conditions are becoming more favorable for technologies that can address these challenges effectively. We are going to explore the potential scenarios that could drive XRP's growth in this environment, including what would need to happen for real demand to increase, how institutional adoption could play out, and why some believe this could be the setup for a much larger move than most people are currently expecting. Now that the connection between global monetary shifts and XRP's core utility is becoming clearer, the next step is to explore the actual scenarios that could turn this setup into real demand. Because understanding potential outcomes is what separates speculation from informed perspective. And when you look at the current environment shaped by rising interest rates, tightening liquidity, and increasing pressure on financial institutions, you begin to see that there are several realistic paths through which XRP could start gaining stronger traction over time. One of the most important scenarios revolves around institutional adoption, because large financial institutions are the primary users of cross border payment systems, and any meaningful shift toward XRP would likely begin at this level. And as borrowing costs rise due to changes like Japan ending its zero interest rate policy, banks are naturally incentivized to reduce unnecessary expenses and optimize their operations. And this is where XRP's ability to provide on demand liquidity becomes highly relevant, because instead of locking capital in multiple countries, institutions can free up those funds and use them more efficiently while still maintaining the ability to move money globally. If even a small percentage of banks begin to adopt this approach, it could create a noticeable increase in demand for XRP, not from retail speculation, but from actual usage. And this type of demand is fundamentally different because it is driven by utility rather than hype. And over time, utility driven demand tends to create a more stable and sustainable foundation for any asset, especially one that is designed to function within financial infrastructure. Another scenario involves payment providers and remittance companies, because these businesses operate in highly competitive environments where margins can be very tight. And when interest rates rise and liquidity becomes more expensive, the pressure to reduce costs becomes even stronger, and solutions that can offer faster settlements with lower fees become extremely attractive. And XRP has already been positioned as a tool that can improve efficiency in cross border payments, particularly in corridors where traditional systems are slow and costly. In addition to that, there is the possibility of increased collaboration between blockchain based solutions and traditional financial systems, because rather than completely replacing existing infrastructure, many institutions are exploring ways to integrate new technologies into their current operations. And this hybrid approach can accelerate adoption because it allows organizations to improve efficiency without taking on the full risk of abandoning established systems. And in such a model, XRP could serve as a bridge between different currencies and systems, enhancing the overall flow of value across networks. Another key factor to consider is market awareness, because as more discussions begin to highlight the connection between macroeconomic changes and digital asset utility, the narrative around XRP can start to shift from speculation to real world application. And this shift in perception is important because it influences how both institutions and retail investors view the asset. And when an asset is seen as a solution rather than just an investment, it often attracts a different type of attention that can lead to more meaningful engagement. There is also a scenario where continued volatility in global markets pushes institutions to prioritize speed and certainty in transactions, because in uncertain environments, delays and inefficiencies can lead to higher risks and financial losses, and the ability to settle transactions almost instantly becomes a valuable advantage, especially when dealing with large volumes in multiple currencies. And XRP's design directly addresses this need by reducing settlement times and minimizing exposure to market fluctuations during transactions. At the same time, technological readiness plays a crucial role, because even if the economic conditions are favorable, adoption can only happen if the technology is capable of handling real world demands. And XRP's infrastructure has already been tested in various use cases, which gives it a level of credibility compared to newer or less established solutions. And this can be an important factor when institutions are deciding which technologies to explore or implement. However, it is important to understand that these scenarios are not guaranteed outcomes, and there are still challenges that could slow down or limit adoption, including regulatory uncertainty in different regions, competition from other blockchain solutions, and the natural resistance to change that exists within large financial institutions. But even with these challenges, the overall direction of the global financial system appears to be moving toward greater efficiency and digital integration, and this trend aligns with the core value proposition of XRP. Another interesting aspect is how timing plays a role in all of this, because macroeconomic changes often take time to fully impact markets and systems. And while the end of Japan's zero interest rate policy is a significant event, its effects will likely unfold gradually. And this means that any potential impact on XRP may also develop over time rather than appearing suddenly. And this gradual progression can sometimes create opportunities for those who are paying attention early, while others are still focused on short term noise. As all these elements come together, institutional incentives, cost pressures, technological readiness, and changing market narratives, the possibility of increased XRP relevance becomes more grounded in real world dynamics rather than just speculation. And while it is important to remain cautious and realistic, it is equally important to recognize when structural changes are creating new opportunities that did not exist before. We are going to bring everything together by looking at the bigger picture, including what this could mean for XRP's long term outlook, how investors should think about these developments, and the key risks and considerations that should not be ignored in this evolving financial landscape. When you step back and look at the full picture, what is happening right now is not just a small policy adjustment in one country, but a signal that the global financial system may be entering a new phase where the rules that dominated for decades are starting to shift. And Japan ending more than 30 years of zero interest rates represents a deeper structural change that could slowly reshape how money moves, how liquidity is managed, and how institutions think about efficiency in a world where capital is no longer cheap and easily available.